Hi everyone, my name is Nicola Sol. I'm a corporate associate at Penningtons Manches Cooper. I'm here with my colleague Attilio Lechasotti, who's also a corporate associate. We're here today to talk about investments. We thought it was quite timely considering the coronavirus pandemic is having a destabilising effect on a lot of businesses. So at a time when growth in most companies is stalling, we've actually seen that a lot of businesses in Oxford are growing despite and even because of coronavirus, especially in the life sciences sector. So if you're a startup company, the way to grow is to have investment. Cash is ultimately king. It means you can afford to employ the people, you can afford to do research, you can afford to expand. And at the minute, government initiatives mean that funding that was once available has now been diverted elsewhere, such as furlough schemes. So after starting up your company and gaining initial capital from friends, families, and possibly angels, the next stage to help you grow and receive money would possibly be to look at venture capital firms or VC firms. So VC firms can offer capital, but they can also offer strategic assistance and introduce you to employees or to partners and much more. The process is time consuming, but it will be worth it in the end. So what we want to do today is give you a little overview of the process, and then Attilio is going to talk in detail about term sheet and what you should expect, what you should fight for, and what the VC firms will ultimately want. So first of all, I'm going to talk about the process. So as I said, it's time consuming. It can take weeks to get a meeting with a venture capital firm. And then you've got to go in front of the investment committee with your business plan. Then there's the term sheet, which we will touch on. Then there's due diligence. And then finally, the legals. Sorry, just looking at my notes. But the first thing you really need to do is think about who you want. And I know you will, as I said, cash is king and you want investment from anyone, but some are ideally placed with your company than others. And that can be because they're in the same industry sector or the same geography, such as Oxford or Oxfordshire generally. And also you really want somebody with the right level so that they invest in seed stage investments, because you then grow together and they will know what you need and what you want, and they'll be able to help you. Unfortunately, rarely do VC firms Google you and find you out. So you will have to do the work to find out who the right person to approach is. An alternative is to have a warm introduction from a colleague or from a friendly legal advisor. The next stage is you would approach them with your business plan. This shouldn't really be like a 10-year forecast. We're looking more at a 1 to 3 year plan. From it, they should get to know the history of your business, where you are now and where you want to be. They will need to know who your customers are, what your likely contracts are, and really why you need their money. The business plan is your pitch document. This is how you will spike their interest from presenting this business plan to them. From the business plan, hopefully you would move to a term sheet. And a term sheet means that they're more serious, but it unfortunately doesn't necessarily mean that it's going to end in investment, but it's definitely the right step. And from a term sheet, there you're going to have to go through due diligence. And I think that lockdown and being stuck in your house or stuck in your office alone is probably the best time to be preparing for due diligence. With due diligence, the investor company is going to drill down into the foundation of your company. They want to know who they're investing in and why they're investing. So they'll want to know financial projections, your material contracts, whether there's any litigation that would divert the money that they're putting into the company, and also what collateral you have through key intellectual property or key contracts. So as I said, in due diligence, they dive down into the company. And this is done mostly through an online data room. So you would put all your contracts up into a lovely ordered website, and then they would go through it and review it. This is a time really to identify any gaps, but what they would really look at is make sure your contracts are up to date. This is with employees, suppliers, and customers. You might think, but of course I've got contracts with everyone, but a lot of them sometimes turn out to be verbal contracts, or it's a rolling contract, so you haven't really checked the terms, but they want to know what liabilities and obligations you as a company has. So make sure you know and make sure everything's in place. Also look at your processes and policies, such as your employee handbook or even your NI and your PAYE, and just make sure everything's in place, everything's up to date. Intellectual property, as I said before, will be something they look at because it's collateral in the company. Have you protected it? And also, is it in the name of the company? We find with a lot of our clients, they say, yeah, we own the website, but actually when you look, the domain name is owned by the head of IT or the employee who set up the website rather than the company. So it's things like that that you can do now and neaten up, that will save time and will show the company is clean and it's exactly the type of firm that the VC firm wants to invest in. Another thing is your premises. Have you got the right license or lease to be there with your company? And then lastly, will you need consent from everyone? So originally you may have got funding from angels or from friends and family and entered a shareholders agreement that said that they need to consent to any funding that you then receive. So make sure that you have checked their documents and you've got the consent from everyone, because again, that can be time consuming, that could be a huge paper exercise, but you want to be in the best position you can be, ready for the term sheet when the VC fund decides to invest. So I'll pass on to Attilio, who will talk about the term sheets and then the main terms that you should look out for.
Excellent. Thanks, Nicola. So you've got a term sheet. Fantastic. Congratulations. Sometimes the term sheets are really detailed and they'll include everything that I'm about to discuss, or sometimes they can be really short form and the detail is left for the legal documents. There's no particular right or wrong approach as long as you negotiate the terms wherever they appear to your advantage. So the key terms in a term sheet broadly fall into two main categories: economics and control. The economics refers to the terms that relate to what financial returns you're giving away to investors, and control refers to the terms that relate to what decision-making powers you're handing over to the investors. Now, I promise it's not all giving stuff away. It's not all bad news when it comes to VCs. They can give as well as take, but it's important that you find the right investor for you, as Nicola was saying, so that they can give you sound strategic advice and open some perhaps previously locked doors. Now, it's important to say that most of the terms in a term sheet are non-binding, but don't write off its importance because of this. The term sheet is really the start of your legal relationship with investors, and it sets the tone for your future dealings with not only the investor who's giving you the term sheet, but all future investors who will see what you've accepted before. So let's dive into the terms themselves, and we'll do the economic terms first. And you may come across a term called preferences. So these will usually come in the form of a liquidation or exit preference and anti-dilution. So unfortunately, they are preferences for the VCs, or the venture capital investor. The liquidation or exit preference comes in two forms, either participating or non-participating. And in a participating preference, the investor has the right to receive a multiple of the amount that they've invested and then share in whatever's left with all the other shareholders. And in a non-participating preference, the investor gets the higher of either a multiple of their investment or the share with everybody else. Now, the norm in the UK is a non-participating 1x liquidation preference. Anything else is simply too onerous. So beware of that one. And then on to anti-dilution. The objective of an anti-dilution preference is to protect the investors in the event of a down round, i.e. a fundraising round where the company's value is lower than the previous funding round. And the formula to calculate how many anti-dilution shares will be issued to the investor in the event of a down round should be on a weighted average basis. The warning here is beware of any investor requesting a full ratchet formula, as this is the most penal to existing shareholders. Moving on to warranties. So the term sheet will usually say that the investor expects warranties to be given by the management team And these are statements that you're making that are, for example, your cap table is correct, the business isn't being sued by anyone, that you own all of your IP. And if the term sheet specifies the giving of these customary warranties, you need to make sure that they are made subject to customary limitations. And these limitations have the effect of limiting the management team's liability should they forget or fail to disclose information which makes a warranty untrue. Now, usually you would want a cap set per founder, which outlines how much they would be personally liable for. And it's customary to cap the founder's liability to 1 times annual salary. Though if you're not being paid anything, if you're a founder in a startup company, it's not unusual that you don't have a salary, then you can just use a fixed figure. It's also helpful to have a floor on financial liability, so a level below which a claim is ignored. So, for example, if you set your floor at £10,000, if the investor's got a claim for £5,000, they can't proceed with it because it's below the floor. Another economic term, although it straddles both economics and control, is how founders' equity vests. Now, in reality, the founders will already own their shares, so the vesting we're talking about here is actually a reverse vesting or clawback of shares should a founder leave the company. Now, typically the vesting period is monthly over 3 to 4 years post-investment, and sometimes it includes something called a 1-year cliff, and this is exactly as it says. If you leave within 1 year, your shares fall off the edge of the cliff, so you lose all of your shares, or a large proportion of those shares. Now, in practice, what the key issues for the founders will be are, should they have vesting credit for time already served? So let's say they get to already bank 75% or 50% of their shares. Secondly, founders shouldn't be made to have shares vested if they have acquired them for a meaningful cash investment. So if you're a founder and you've invested alongside external investors on the same terms at the same valuation, those shares should not be subject to vesting. And thirdly, also think about acceleration of vesting. So where you get to keep all of your shares if the termination of your employment was without cause, or if your employment ceases because of a sale of the company. Another economic term is share option pools. So normally investors will want to see that a percentage of the company set aside to incentivize employees or to attract new employees. Typically, we see this level set at 10 to 20% of the company. So it's just something to bear in mind, that your ownership may be diluted by that amount that you're setting aside for your employees. So that basically covers off the economic elements. We'll now move on to the control elements. So as investors will often hold a minority interest in the company, they will insist on protective provisions or veto rights. Now, most of the matters requiring investor consent should focus on 2 things. The first is limiting the founder's ability to take cash out of the business, except for what's been agreed in the business plan. And secondly, any alteration to the rights of the shares that the investors have. Basically, those 2 things are what you should set your veto rights at. Anything more, beware of. So investors will also want the right to appoint a number of directors to the board and or have a board observer. Our top tip here is to make sure that it's one or the other. Don't let them have both, otherwise your board table will get too crowded. Investors also insist on information rights on a regular basis so they can monitor their investment. And our tip here is to ensure the level of investment or the level of information given reflects the investment and doesn't leave you preparing endless reports instead of running the business. And now, holding a minority interest, the investors will want to ensure they have certain benefits in relation to a sale of the company. One of those benefits is called a tag-along right, and it basically means that they can participate on the sale of a majority of the company by making the buyer of that majority also purchase their shares. And the opposite of that is called a drag-along right, where the majority of shareholders can drag along the minority. Now, with the investor being a minority, they'll want to make sure that that drag-along threshold or percentage is set at the right level, so that they are not dragged along by, let's say, 50 or 60%, but they're more dragged along by 75 or 80% of the shareholders. Now, all the aforementioned terms are non-binding, as I said before. However, there are some terms in a term sheet that are binding. One of them is exclusivity, i.e. how long the investor has an exclusive opportunity to invest before you go and seek other investment. The top tip here is to keep that period as short as possible. The other legally binding term is costs. So it's not uncommon for an investor to ask you to cover their professional costs when they're making the investment. Sadly, that is one of the unfortunate terms of investment, that you're almost paying the investor for the pleasure of having their money or receiving their money. So the top tip here is to put a cap on that expenditure to give you some certainty. And then lastly, we could expect a governing law term to be legally binding, and that would just say which law or jurisdiction governs the terms of the term sheet and any documents that flow from that. And again, if you're an English company, you would want that governing law to be England. Now, clearly these deal terms can shift power in favour of either investors or founders. So the art of the negotiation of the term sheet is getting the balance right to safeguard everyone's interests, but doing so in a way that you can get to close the round really quickly and efficiently. I know Nicola and I have seen rounds still open for months with founders and investors haggling over totally trivial deal terms, and that's just not the way to scale your business. So, in these unprecedented times, it's no surprise that VCs are certainly in a stronger negotiating position as companies become increasingly desperate to secure investment. So, beware of that and try to push back on those areas that are really key to you as founders, and some of them that I've flagged before. So you've heard a bit about the process, and I've given you a summary of the likely terms. So I'm going to move on to some of the issues, problems, top tips that we would normally give our clients. So the first one is really beware the scattergun approach when talking to investors and trying to attract investment. As Nicola said, unsolicited emails will often go ignored. So if you can get a warm introduction from a lawyer or an accountant, hopefully that should at least elicit a response. Secondly, always consider confidentiality before you start disclosing information to investors. It's not always common to get investors to sign up to a confidentiality agreement, but if you have got particularly sensitive information or you're an IP intensive company, don't be embarrassed about requesting a confidentiality agreement be signed before you start to disclose information. Thirdly, take time and effort to value your business sensibly. Your pre-money valuation is probably the most important figure in the entire investment process. So credible investors will be put off if you value your business too highly, especially as there's just no guarantee that things are going to pan out as you hope. But at the same time, don't give away too much in the rush to secure funds. It's really important that you do crunch the numbers, keep your figures realistic, and speak to your accountants, get them involved if necessary. Next point is always ask for enough money. Investors will want to know that you won't be back asking for more cash in a few months' time. They'll want to know that you've assessed your finances and your cash runway, and that you've been accurately working out your investment needs for your business. The next point is Have that business plan credible, but keep it short. If you want to be taken seriously, spend enough time on your financial forecasts, and do at least a month by month forecast for your first year, and then maybe an annual for years 2 and 3. But try not to go beyond that. There really isn't any need at this point. And then the last tip is really learn from your mistakes. If you don't get funding from the first pitch you make, ask for and listen to that feedback, and then make sure you're prepared for your next pitch. Don't give up at your first stumbling block, and perseverance is really the key when embarking on an investment process. So that wraps up the presentation. I think in conclusion, from our experience, venture capital and investment of this nature is crucial to the success of many startup businesses. And there's no doubt by understanding the key issues that we've gone through, you can really increase the likelihood of a successful outcome. And hopefully what we've discussed will help you along the way.